and Gustavo Frank of Los Pollos Hermanos.
How many times would they say I'm the smoothest? Truth is I never not moved this way. My trench coat leather, my shoes are suede. Beg you don't step on my Pumas, babe. Walk the ages in these trainers, but I ain't tripped when they losing faith. You know I've been tested without a question why they on net doing Q&A.
Okay, I'm assuming because you clicked on this video that you're looking to raise capital for your company or for your startup. Now, before I get into the specifics and the tactical side of things, let me just explain who I am and why you should listen to what I have to say. So over the past 2 years, my firm has helped secure over $600 million in term sheets and capital commitments for our clients. Our clients are anyone from seed to Series B venture companies looking to raise early rounds, all the way up to commercial scale project finance, utility scale renewable energy companies. So we've had insight into various situations across different industries, deal types, and verticals. A key piece also of what we do is we work directly on behalf of a number of institutional funders as well as family offices to help them originate deals and source good opportunities for them to place capital into. Okay, so you want to raise capital. And what I will say to that is now is as good of a time as ever to raise capital. It's important for you to understand the economic conditions that you're raising the capital in, because that will influence how hard or how easy it is for you to get an investor to say yes. So in 2025, I would say things are pretty good. It's not 2016 where you could get funded off a pitch deck and a dream. What I will also say is it is not like it was in post-COVID either. This is what economists called the era of quantitative tightening. So this is where high interest rates caused a lot of investors to be a little more risk off and hold their money and refrained really from making investments. And what that led to was an extremely competitive fundraising environment. So 2025, we're actually seeing a lot of urgency and a lot of people eager to deploy all of this dry powder. So we're coming out of this more dormant era into an era where people are really looking for great opportunities to invest. So there is no shortage of capital. And if anything, in my experience, most of the funders we work with can't deploy money fast enough. Okay, so with that out of the way, here is how you actually go about raising capital. There's sort of two different paths you can take. One path would be to hire a capital advisory firm, an investment bank, something similar to my firm. But that's probably not going to be possible for a lot of startup founders because the cost is very prohibitive. I mean, we're looking at $25,000 to $100,000 in retainer fees. So what that leaves is the second option, which most people go for, which is to run their process internally. So the first piece of advice here is you need a process. You need to systematize this as if you're running a go-to-market strategy. We treat fundraising like a marketing funnel. Top of funnel, it's the same thing. How do you get investor interest? How are you getting traffic to your offer? Your offer in this case is your capital raise. Middle of the funnel is you're taking the meetings, you're qualifying them as much as they're qualifying you, and you're selling them. Bottom of the funnel is conversion. That's when you're looking at the term sheet, ironing out the specifics, and ultimately getting the transaction across the line. So by treating it like a marketing funnel, that means you're going to operate in a similar way that you would in marketing, right? You're going to run an outreach process. So this is LinkedIn, this is cold email. You're going to target investors based on signals. So getting a good list together of who is deploying, right? Don't reach out to people if they haven't recently been active and actively deploying money into the space. Look at the average check size. If you're trying to raise $5 million as a seed, right? You're not going to go after a private equity firm who looks at deploying at least $50 million into more growth stage companies. So it's important that you match up the check size and the stage. Secondly, you want to be able to find out if they've invested into companies that fit your company's profile. A good tip that I'll use is you can use things like Clay, you can use things like PitchBook, and say your company is a clean tech company. So what you would do is you would find an investor on PitchBook or Clay, and it would list out their recent investments. And if it looks like it's a good fit for you, you can use those investments in your first line in your email. It's personalized. Say, hey, based on your investments in XYZ, I think we would be a great fit for you. So this is all research you need to do, and then go ahead and build that list, focusing on those pieces of criteria. All right, so you have your list of target investors. So this should be about 200 to 500 at the first stages, and then from there you can go out and expand it. The next step, and a very crucial element, is you're going to have to reach out to them at scale. So I mentioned LinkedIn and cold email. A lot of times people tell me, oh, I reached out to 20, I reached out to 50 investors and I only got 1 or 2 responses. It doesn't work. And that's because you're just not doing enough volume. In marketing, a good response rate is anywhere from 4 to 7%, if we're being realistic, to an entirely cold audience, right? So 4 to 7%, you're not going to change those response rates. You might get them a little higher, but the variable that you're going to want to move, the lever that you're going to want to really mess with, is the volume, right? 4 to 7% response rate on 50, that's not good. 4 to 7% on 1,000, 2,000, 5,000 starts to look pretty good. And another thing I will say too is doing it at scale also means following up. So using a software like Instantly, Email Bison, to name a few. You can automate and schedule follow-ups. So if they don't respond, it will automatically follow up in 3 days. And a fun fact, or a key piece of data that a lot of people don't realize, and this is true from our own experience, I would say the majority of responses to our outreach come on the second email, so the first follow-up. So you're leaving a lot of conversations on the table if you're only reaching out once and not following up in a strategic and diligent way. So if you do all of this right, you should be having 5 to 10 conversations a week. And what that means is you can hopefully close capital in as soon as 30 to 60 days if you've done this right. So the last thing I'm going to touch on here is, and it probably goes without saying, but a key piece of fundraising is you're going to need 2 things. The first is a pitch deck. Now, there's a lot of guides you can find online about what a good pitch deck is, and I'm happy to make a video on that at a later date as well. But the one thing I will say on the pitch deck is you need to include one of the biggest and most essential pieces of the pitch, which I see so many founders leaving out, and that is the why now. What do I mean by that? So you could have the best team, incredible revenue metrics, right? All day long, investors, while they're in the business of venture capital, they're some of the most risk-averse people you'll ever meet. They always like to see where other venture capital firms are deploying. They'll say things like, oh, come back to us when you have a lead investor, or once you hit this revenue threshold, then we'll invest. But by the time you've done both of those things, you don't need their money anymore. So how do you get them to act? It's the same principle in sales and marketing. You need to create urgency. You need to create FOMO. You need to create scarcity, right? These are 3 different things that you can use to get the funders to move quicker. Because, again, you want to articulate to them why this opportunity, why in the next 1 to 2 months, this opportunity will go away. Hey, if I have $5 million today, here's what we're going to be able to do. Here's the opportunity we will be able to take advantage of. Because otherwise they're incentivized to just, we'll invest next round, or okay, we're going to wait and see until you've de-risked it enough for us to come in. So the best way you can solve against that is, again, creating a sense of urgency. And the last thing you're going to need in terms of fundraising is a data room, which just is a Google Drive or Dropbox folder that contains all your financials, your product information, your deck, just a one-stop shop so investors can quickly get a holistic view of your business and evaluate it quickly and efficiently. So thank you guys for watching this video. Let me know in the comments what you'd like to learn more about, and I will make a video about it.